I think most of us are familiar with what a lease is. You've got a definition over here on the left. If you are the lessee, you're leasing an asset from the lessor, the person who legally owns that asset, then you're paying that lessor some amount of cash periodically so that you have the right to control and use that asset. For accounting purposes, things have gotten really interesting. We've had a major change in how we do accounting for leases, and effective for the first time in 2019, lessees are going to be required to record an asset on their balance sheet and a lease liability on their balance sheet for almost all leases. You'll see at the end of our discussion that there is a very limited exception for short-term leases. So what this means is, for example, if you go out and lease an asset, let's say you lease a machine, and let's say that machine has a 10-year life, and you just lease it for a couple of years, the accounting that you would probably expect is that you would just deduct your payments as lease expense in each of those 2 years. What the accounting rules would now require you to do is actually put that asset on your books with a related liability. And that's going to be the case, as I said, for almost all leasing arrangements. Exactly how we do that accounting is going to depend on how we classify leases. For a lessee, we'll be classifying leases as either operating leases or finance leases. An operating lease would be the type of situation that I described just a moment ago, where you really aren't getting all of the risks or rewards of ownership of that machine. You only used it for 2 years, you paid for that, and then the machine goes back to the legal owner. The other type of leasing arrangement is something that we'll call a finance lease. And under a financing lease, the lessee is basically getting all of the risks and rewards of ownership of that underlying asset. So it's always made sense to put an asset and a related liability on the books when you had this type of situation. We used to call those capital leases. What's interesting and new is that we now have a similar sort of balance sheet result for operating leases as well. Lessors do a similar kind of accounting. They call their 2 types of classifications operating leases and sales type leases. The accounting for leases from the viewpoint of the lessors is actually beyond our scope. We're really going to focus on the accounting from the lessee's viewpoint, but you'll see a few slides where I compare them side by side like this, and basically the lessors have sort of a mirror image accounting that follows the same idea. When you have a leasing arrangement that transfers substantially all the risks and rewards of ownership to the lessee, then it makes sense that for accounting purposes, the lessor is going to treat that as if they actually sold the asset to the lessee. On the other hand, when you don't have that type of arrangement, lessors will generally be reporting for operating leases as just periodic receipt of lease revenue. Well, let's take a look at how we decide whether a lease is an operating lease or a financing lease for a lessee. Again, lessors would use these same criteria. Our focus is just going to be on accounting from the lessee's viewpoint as a measure of simplification. If because of the structure of a lease, any one of these 5 criteria are met, the lease will be classified as a finance lease for the lessee. If none of these 5 criteria are met, the lease will be an operating lease for the lessee. Let's walk through these. We have a financing lease when the lease agreement specifies that ownership of the asset will transfer to the lessee. So obviously if the lessee ends up owning the asset, then they truly have been transferred all of the risks and rewards of ownership of that asset. Similarly, this next bullet says that if there's a bargain purchase option in the lease, so we're talking about a situation where at some point during the lease term the lessee is offered a chance to buy that asset and the purchase price is low enough that it's reasonably certain the lessee will buy that asset, well then that's basically the same situation as in the first bullet here. So once again, we would call that a financing lease. The third bullet here says that we have a financing lease if the lease term is for a major part of the economic life of the asset. So we'll define major part to be more than 75% of the remaining economic life of an asset. So this criteria should make some sense to you as well. If you lease an asset with a 10-year life and you're leasing it for 8 or 9 years out of that 10 years, then basically you're getting substantially all of the risks and rewards of ownership of that asset, and we'd have a financing lease. On the other hand, if you're only leasing that asset for a few years, then it would be classified as an operating lease unless, again, it met one of the other criteria here on this list. The fourth bullet says we have a financing lease if the present value of all of the lease payments equals or exceeds substantially all of the fair value of that asset. Here we'll be defining substantially all. Generally, people interpret that to mean 90% or more of the fair value of the underlying asset. And this is a pretty practical rule as well. If your lease payments are so high that basically you're paying fair value for that asset, then we should account for it as if you've purchased it rather than you're just using it. And the final bullet here is a little bit more unique than the rest of them. It says that we're going to treat this as a finance lease, again with more of a purchase feel to it when you look at the underlying accounting here in a little while. It'll be treated as a finance lease if the asset is very specialized, such that it's not going to have any alternative use to the lessor at the end of the lease term. If that's the case, the lessee has enjoyed substantially all of the risks and rewards of that asset. Well, let's take a look at how we account for these two different classifications of leases, finance leases and operating leases. And this is just at a very high level. We'll do examples in a little bit, and the examples will help a lot in making sense out of these rules. Let's take a look at the rules for finance leases first. Finance leases used to be called capital leases for accounting purposes, so we've changed some terminology here, but the accounting for finance leases is actually pretty close to what it has been for a very long time in financial accounting. When a lessee has a finance lease, they record on their balance sheet a right-of-use asset and a lease liability. They record those two things at the present value of all of those future lease payments that they're going to be making. On the income statement, with a financing lease, the lessee will have slightly higher total expenses recorded on the income statement in the early years of a lease compared to the later years of a lease. In other words, it's similar to if you purchased that asset with debt, you'd have like a straight line depreciation cost, but you'd have higher interest expense in the early years of that asset's life than in the later years. So on the income statement side of things, we'll be recording interest expense on the lease liability, just as if you'd purchased it with a loan, and we'll record straight line amortization of that right-of-use asset, similar to straight line depreciation expense. Operating assets are where we've seen the big change just recently. It used to be that when a company classified a lease, when a lessee classified a lease as an operating lease, they did not put anything on their balance sheet for that lease, and that has changed dramatically. Now, when there's an operating lease, the lessee still has to record a right-of-use asset and a lease liability equal to the present value of those future lease payments. The difference is when there's an operating lease, the total amount of expense related to the lease is going to be the same every year. So if you make the same lease payment every year, the total amount of expense you'll report on your income statement will be the amount of that lease payment. So as far as the income statement goes, the change is not very dramatic. I'll talk to you when we do an example about how we actually record that lease expense. We record it in two parts, part interest expense and part amortization of the right-of-use asset. But we compute this amortization of the right-of-use asset such that when you add these two things together, they're equal to the amount of lease expense that the lessee is paying. So the big change for operating leases is actually not on the income statement, it's on the balance sheet. It's the fact that now even an operating lease is going to show up on the balance sheet as an asset with a related lease liability. I'll show you here accounting for sales type leases and operating leases for a lessor, but we won't actually be doing any examples with lessor accounting. As you can see though, it is sort of mirror image of what we do for the lessee. In a sales type lease, the lessor basically acts as though they sold that asset. So they record a lease receivable, they remove the leased asset from their books. If the lease receivable is greater than the cost of the asset, they would record a profit on that, and in the future they record interest revenue on the receivable as they collect each one of those lease payments. If it's an operating lease, the lessor leaves that leased assets on their books, they continue to depreciate it, etc., and they just record lease revenue on a straight line basis as they get the payments. I've said that whether it's an operating lease or a financing lease, the lessee needs to record a right-of-use asset and a lease liability equal to the present value of all of those future lease payments. Well, what do they use as an interest rate to compute that present value amount? Generally, the lessee is going to use the lessor's implicit rate. So this is the rate that the lessor used when they were determining what their required lease payments would be. So as long as the lessee has that information, they would use that implicit rate to do their present value computations. If the lessee doesn't know the lessor's implicit rate, the lessee just uses their own incremental borrowing rate. I won't ever require you to make those decisions. I will just give you the rate, or you will assume that the lessee does indeed have knowledge of what the lessor used as the implicit rate.